welcome to The Explainer. Today we're looking at massive multinationals, not just as boring businesses, but literally like living, breathing organisms. We're going to map out their skeletons, check their vitals, and dive deep into their internal metabolism. It's a fascinating look at how modern business empires are built, how they actually keep score, and how they navigate the incredibly complex world of global taxes. I am so excited to unpack this with you, so let's just jump right in. Okay, here's our quick roadmap for The Explainer. First, we're building a corporate family. Then, we'll learn how to tell the financial story. After that, we'll break down assets, liabilities, and cash. And finally, we'll tackle the transfer pricing puzzle. Section 1. Building a corporate family. The holding company mechanics. Because look, before an empire can conquer the world, it absolutely needs a skeleton to give it shape. To really grasp corporate structures, we have to start with the absolute basics, the parent and the daughter. At the top, you've got the holding company. This is the parent, and honestly, its main job is just holding a controlling interest. That's it. Down below, connected by these financial lifelines, are the daughter companies, the subsidiaries. These are the ones actually getting their hands dirty, right? Selling the cars, writing the software, managing real estate. The holding company just sits above the fray, orchestrating the whole setup and, of course, soaking up the profits those operating daughters generate. But you might be wondering, why go through all this trouble? Like, why not just run everything as one massive company? Well, it really boils down to two huge advantages: risk management and optionality. On the risk side, think about it. If one daughter company gets hit with a catastrophic lawsuit or goes bankrupt, the parent company can just fence off that problem. The toxic risk is completely isolated in that single subsidiary, keeping the rest of the family perfectly safe. And then there's optionality. This is all about ultimate flexibility. You want to start a new venture? Boom, just snap on a new subsidiary. Ready to exit an industry? Sell off that specific daughter company and the rest of your empire doesn't even blink. It also lets the parent company secure massive top-level financing and then sprinkle that cash down to the operating units however it sees fit. Now, what's really fascinating is seeing this in the real world with a giant like Xstore, one of the biggest diversified holding companies on the planet. Look at the immense leverage they get from this strategy. They use an ultimate holding company structure to wield way more power than they actually pay for. For instance, they hold about 20% of the economic ownership in Ferrari, but they somehow control 32% of the voting rights. Same deal with Stellantis, just 15.5% economic ownership, but a massive 24% of the voting rights. This structure literally lets the holding company steer the entire empire without having to front anywhere near 100% of the capital. It's a total game changer. Okay, let's transition to our second pillar, telling the financial story. If the holding company is the skeleton, the financial statements are the vitals. And there's a brilliant way to think about these reports. Just think of it as the movie versus the snapshot. The income statement and the cash flow statement, those are movies. They show you exactly what happened over a specific period of time, like a quarter or a whole year. You just sit back and watch the revenue roll in and the expenses roll out. But the balance sheet, that is a snapshot. It's a frozen-in-time picture of exactly what a company owns and owes on one specific day, say December 31st. Keeping that movie versus snapshot idea in your head makes it so much easier to intuitively grasp exactly what story a financial report is trying to tell you. So let's look at a movie, the income statement, using a company we all know, Microsoft. Now, let me challenge you for a second. If I asked you where Microsoft makes most of its money today, what would you guess? Windows? Xbox? Well, look at that massive slice of their revenue pie. A staggering 66%, literally 2/3 of their revenue, now comes from server, cloud services, and Microsoft 365 subscriptions. They have completely transformed their entire revenue engine. And wow, what an engine it is. In their 2025 fiscal year, Microsoft's top-line revenue was an absolutely eye-watering $281.7 billion. Just wrap your head around that. That is the sheer unbelievable scale of the sales they generated over that 12-month movie. But as we all know, it's not about what you make, it's about what you keep. Their bottom line, the net income, came in at an incredible $11.18 billion. If you run the math on that, it's nearly a 36% net profit margin. From a shareholder's point of view, taking more than a third of every single dollar of sales and turning it into pure profit, that tells you this is an incredibly healthy, completely dominant business. All right, moving on to our third pillar, assets, liabilities, and cash. We're going to pause the movie here and look at the snapshot to see the great balancing act of what the empire owns versus what it owes. The absolute golden rule of a balance sheet is literally in the name. It has to balance. On one side, we have what Microsoft owns. That's their current and non-current assets, totaling $619 billion. Over on the other side, we see exactly how they paid for those assets. It's a mix of liabilities, so what they owe, and shareholder equity, which is basically the book value of the shareholders' capital. And look at that, exactly $619 billion on both sides. It perfectly balances, right down to the penny. Now, hidden inside those non-current assets is this incredibly fascinating concept called goodwill. You might have wondered what actually happens when a company dramatically overpays to acquire another business. Well, goodwill is literally the accounting plug that makes the acquisition journal entry balance. It's true. When Microsoft bought Activision, they were paying for future expectations, not just hard physical assets. So after tallying up Activision's tangible and intangible assets, there was still this massive gap in the math. The solution? A staggering $51 billion plug of goodwill, just dropped right onto Microsoft's balance sheet to make the numbers work. Crazy, right? Let's step back and see how all of this feeds into their cash flow. Any healthy company needs cash to survive, and Microsoft is just a cash-generating machine. Look at their operating activities, a positive $136.2 billion. Because they throw off so much cash from their everyday operations, they can effortlessly self-fund massive investments, which is that $72.6 billion outflow, and they can pay back loans or buy back their own stock. That's the $51.7 billion financing outflow. And after all of that, they still end the year sitting on a mountain of over $30 billion in cash. Finally, we reach our fourth pillar, the transfer pricing puzzle. If the corporate structure is the skeleton and the financials are the vitals, transfer pricing is the complex internal metabolism that regulates value across global borders. Here's how it works. When different parts of the exact same corporate family buy and sell from each other, they still have to set a price. Let's look at a quick scenario with a made-up company, MedDevice. They manufacture in Ireland and sell to their sister company in France. Now, France has a 25% tax rate, while Ireland's is only 12.5%. If they set the internal transfer price really low, say 40,000 euros, all the actual profit lands in France. That means a hefty tax bill of 15,000 euros. But if they set that internal price artificially high, at 100,000 euros, suddenly all the profit shifts over to low-tax Ireland, slicing their tax bill in half to just 7,500 euros. As you can imagine, multinational enterprises actively optimize this to avoid paying a single cent more in tax than they absolutely have to. But hold on. Here's the catch. You can't just make up imaginary numbers to dodge taxes. If you try to push an extreme, totally artificial transfer price, the tax authorities in France or Ireland are going to reject it outright. And you could end up facing massive fines or worse, double taxation, literally paying taxes on the exact same profit in both countries. Which begs a really critical question. How on earth is the right price actually determined without bringing down the wrath of international tax agencies? The answer lies in the absolute golden rule of international tax law, the arm's length principle. Simply put, this means the internal price between two corporate family members must be the exact same price they would use if they were completely independent strangers negotiating out in the open market. The underlying philosophy here is profound, but really simple. Corporate taxes absolutely must be paid exactly where the profits are genuinely earned. So to actually prove to the government that their pricing is fair and at arm's length, corporations have to perform what's called a functional analysis. It's essentially a three-step story. Step 1, what economically significant activities does each branch actually perform? Step 2, what assets like physical factories or intellectual property are they actually using? And step 3, what risks are they assuming? If a particular subsidiary is taking on massive risk and doing all the heavy lifting, well, they're fully entitled to a larger share of the profits. So the crucial point here is how you map that value creation. Looking back at our MedDevice example, the French branch is out there handling the marketing, the customer relations, and they take on the product liability risk. The Irish branch, meanwhile, is handling the physical manufacturing, the inventory, and the fixed asset risk. By perfectly matching the internal transfer prices directly to the real, functional value created by each side, a multinational business can confidently defend its tax strategy and completely solve the transfer pricing puzzle. Wow, we have really covered some ground today. We've unpacked the holding company skeleton, we've learned how to read the financial movie and the snapshot, and we've cracked the code on global taxation. These are the literal underlying forces driving the biggest empires in the world today. So I want to leave you with this provocative thought. Now that you've seen the hidden mechanics of corporate structures, balance sheets, and global taxes, how will you look at the next big business headline differently? Thank you so much for joining me on this Explainers, and I highly encourage you to keep questioning the numbers behind the